There are countless ways to allocate your capital, but most advice is noise. Blindly following trends usually results in mathematical wealth destruction. We are ranking every major investment class from F to S tier, looking strictly at historical data and verified returns. We'll apply a strict mathematical test. If you deploy a $100,000 capital block into each level, what exactly happens to your baseline? Before anyone can engineer the life-changing velocity found at the top tiers, you first have to identify and survive the traps designed to liquidate your capital. The bottom of the list is F tier. These are highly aggressive financial traps masking as investments. Americans burn over $100 billion a year on lottery tickets, chasing odds of 1 in 300 million. You are statistically more likely to be struck by lightning than to build structural wealth here. The same wealth destruction applies to consumer luxury goods. A brand new sports vehicle strips away up to 50% of its equity within its first 5 years. As Warren Buffett warns, consumer vehicles are the absolute worst destination for capital if your goal is an actual return. Then there are speculative fads acquired without industry expertise. In the 1990s, Hyperloops convinced buyers that Beanie Babies were a shortcut to a fortune. But without deep network access and asymmetric market data, exit liquidity simply vanished. A massive paper appraisal means nothing with no cash buyers. F-tier assets trick your brain into feeling rich while guaranteeing the evaporation of your principal capital. Moving up one level, D-tier assets sit just above the liquidation zone. Unleveraged physical commodities like gold and silver excel at preserving purchasing power during a crisis, but they sit completely passively inside a vault. Over a 50-year window, gold hovers around a 7% annualized return. It prints no dividends and produces zero cash flow. A single mom-and-pop rental property shares this same extreme fragility. On paper, the tenant pays your mortgage. In practice, a single extended vacancy, an unexpected roofing failure, or a localized property tax spike instantly flips the math from positive cash flow into a bleeding liability. C-tier assets are slightly better, functioning as stable parking vaults. High net worth operators buy 10-year U.S. Treasury bonds exclusively for structural stability, not expansion. They deliver a predictable 4 to 5% yield, which simply matches the cost of living increases. Your capital survives, but its purchasing velocity goes nowhere. Public real estate investment trusts, or REITs, also sit here. They distribute mandatory dividend streams, making them highly popular, but their valuations are intensely sensitive to macro forces. When the Federal Reserve aggressively hikes interest rates, REITs can trigger deep drawdowns exceeding 25% in a single cycle. Even expert-level fine art functions as a parking vault. Ultra-high net worth portfolios allocate about 5% to fine art to store value, but liquidating a masterpiece at its true appraised price can consume years of market positioning. It is an incredibly illiquid asset. D and C tiers will successfully insulate your capital from complete ruin, but their internal velocity is far too slow to ever accelerate you toward financial independence on their own. B tier is the precise marker where professional wealth compounding begins. These assets are highly repeatable, completely proven, and require absolutely no insider connections to scale. This line chart tracks the historical velocity of a broad market index fund following the S&P 500. A standard $10,000 block invested in 1980 curves exponentially upward, scaling past $900,000 today on a completely automated buy-and-hold strategy. Vanguard founder Jack Bogle institutionalized this exact model, bypass the noise of individual stock picking, and simply ride the structural growth of the entire economy. This diagram shows the acceleration loop of a dividend aristocrat. These are blue-chip companies that have systematically increased their cash payouts to shareholders for 25 consecutive years. Corporate profits feed into mandatory dividends, which then automatically reinvest to multiply your underlying share base. Scaling residential real estate completes the B-tier list. While a single rental is fragile, the math flips completely in your favor the moment you scale to control 5 to 10 distinct units. At this density, the severe individual vacancy risk is completely decentralized across a broader cash flow footprint. B-tier represents the ultimate automated baseline. The math works for anyone who executes it. The only trade-off required to cross the millionaire threshold is about 30 years of disciplined patience. A-tier assets operate as highly optimized multi-million-dollar wealth engines, but they enforce severe entry barriers to keep the general public out. Top-tier private equity funds consistently capture substantial alpha, delivering historical annualized returns between 12 and 15%. But the Gatekeeper requires a mandatory minimum entry ticket of $250,000, locking your capital inside a corporate vault for up to 10 years. This flow structure maps out a triple net, or NNN, commercial real estate lease. Unlike residential housing, your corporate tenant is legally bound to pay the property tax, structural insurance, and daily maintenance directly. A pure net cash flow spread passes straight to your balance sheet with zero operational deductions. The blue-chip franchising model offers similar cash flow reliability. Operating a dominant brand yields highly consistent annual profit, but acquiring that territory right demands a total initial capital layout ranging from $500,000 to over $2 million. The brutal truth of A-tier is that our $100,000 capital block is mathematically insufficient to clear the gatekeepers. The yields are incredible, but you are locked out of the arena until you build liquid leverage elsewhere. The absolute apex of capital generation belongs to S-tier. These assets completely break the linear link between your human time and your capital accumulation. They combine explosive asymmetric upside with infinite scalability. Owning an independent, profitable business enterprise pays the architect twice. First, through continuous cash flow distributions, and second, through a massive capital injection when the system is sold to private equity at a high multiple of its actual earnings. Securing early-stage equity compensation inside high-growth technology pipelines commands legendary power. A flat $10,000 seed investment deployed into Amazon's 1997 IPO scales past $1.6 million today. These are rare hits on the global matrix, but they construct unassailable dynastic wealth. This balance scale illustrates the exact math of a scalable digital property asset. An initial upfront time investment creates a digital product, code, or media structure, which then replicates infinitely with near-zero marginal production costs. Automated pipelines distribute it to millions of global consumers, commanding uncopyable 95% net profit margins. S-tier assets are the only structurally sound vehicles capable of generating life-changing wealth velocity for an operator starting without millions in liquid capital. The tier list is complete, and the variables are assigned. Now we apply this abstract math directly to your current life scenario to formulate a practical battle plan. If you operate a demanding day job and hold under $100,000 in liquidity, your objective is the passive path. Systematically funnel every available dollar into B-tier heavy lifters. Automate the reinvestment and let decades of compounding do the heavy lifting for you. If you demand absolute financial detachment before age 50, you must take the active path. You have to trade your uncompensated labor upfront to architect a scalable S-tier digital asset or a private business enterprise. Regardless of which path you take, the overarching role of wealth preservation remains exactly the same. Completely avoid the high-emotion consumption traps of F-tier and refuse the mathematical stagnation of D-tier. True financial architecture requires you to choose between slow, reliable automation or intense, concentrated building. Drop a comment below and declare your allocation strategy. Lock in your roadmap, avoid the traps, and keep building.